Hi, it's Chantel again, and I am so excited to dive into financing with you. This is arguably the most important component to you investing in real estate and scaling your portfolio. Financing has been the most exciting and the most difficult part of me scaling my own portfolio, which is now worth about $7 million in real estate. Financing for a full-time real estate investor is so crucial because if you're purchasing multiple properties, this is an expensive habit and hobby. In traditional financing, a lender is going to be involved. And then in non-traditional financing, there are ways to purchase properties without a lender involved at all. We're going to focus on all of the traditional financing methods with a hint of some non-traditional financing methods available to you. We're going to go over primary residence options for single families as well as multifamilies, VAs, FHAs. We're going to go over second home options, investment home options, vacation rental options, DSCR loan options, and more. So let's start with traditional financing terms. So in this video, we're going to talk about down payments, interest rates, amortization schedules, closing costs, and your monthly mortgage payment. So let's start by defining some of these. And I think the easiest way to define some of these is to use an example. So let's say that you are looking to purchase a $500,000 property. You're going to need to bring a down payment for this property if you're using traditional financing. Depending on how you intend on acquiring the property, that's how your down payment is going to be defined. A down payment is simply the amount of cash you are putting into the deal. The rest of the money is going to come directly from a lender or a bank. Interest rates are the amount that a bank is charging you to lend you the money. Interest rates in the pandemic were super low. They were at 3%. At the time of this recording, we're in interest rates that are between 7 and 8%. Interest rates are defined by your credit score as well as the Fed sets the interest rates. This is going to impact how expensive your monthly payment is on your mortgage. Term is the next factor. How long are they going to allow you to pay back this loan? So if it's a $500,000 loan over a term of 30 years, with an interest rate of 7%, your monthly payment is going to be dependent on how long you have to repay that loan, plus your interest rate, plus your down payment, plus your credit score. So let's get started with primary residence options. This is a great option for people that are brand new to the space. Let's say that you're someone who is interested in doing short-term rental, but maybe you don't have a lot of cash at the moment. A primary residence loan will allow you to acquire a property with as little as 0% down up to 10% down. 0% down loans are best utilized if this is your first ever purchase. So the benefit to this is you put very little money down. Even though it's called 0% down, typically they're going to want at least 1% into the deal. So if it's a $500,000 property, you actually likely will get most of your down payment back at some point during the transaction, but they'll likely want to see at least $5,000 into the deal, and this might go towards your closing costs. Closing costs are referring to the additional costs with purchasing a property that's not your down payment. So in some scenarios, closing costs are as low as 1%. So if it's a $500,000 property, you might have $5,000 in closing costs in addition to your down payment. In some markets, closing costs will be as much as 5%, but it just kind of depends on where you're purchasing the property, the interest rate, your credit score, and the type of product that you're getting. So let's say that you're buying a primary residence with 0% down. You'll likely have at least $5,000 in closing costs. The benefit to this is you have very little out-of-pocket money, and you can use those funds instead on focusing on furnishing, adding amenities, or doing any renovations. In this scenario, you are saying to the lender that you intend on living in the property for at least a year. Other options would be 3.5% to 5% down. So there are FHA loans as well as traditional conventional loans. An FHA loan with 3.5% down allows you to obtain a loan if your credit score is a little bit lower. Typically, we see an FHA loan willing to work with credit scores as low as 580, whereas a conventional lender wants to see something around 680. So an FHA loan is a great product if you haven't established a lot of credit or if your credit score is lower and you want to be able to utilize a lower down payment. They're also more liberal when it comes to your debt to income. So when you are purchasing a property, a lender is basically going to look at what is their job situation, how much money do they make every single month, and what amount of cash do they have to put towards a down payment. And all of these factors will qualify you for a purchase of a property. And you do want to get qualified for a property before you start your home search because you want to know exactly how much you can borrow and the best use of those funds. So after you're qualified through the lender for your primary residence loan, you'll determine a product between 0 and 5% down, and you'll be saying that you're going to be living there for the next year. In this scenario, we have a lot of people that will rent out separate basements or bedrooms or guest homes. That's actually how my husband and I started. We did a 3% down product using a conventional loan. We purchased our property for $440 back in 2017, and we started off by living upstairs and renting a separate unit in the basement. This was so great because then we had cash still as a cushion to be able to furnish that basement. At the time, it cost us about $7,000 to furnish that basement, and we started renting that basement and it was covering our entire mortgage. After that, we ended up building a guest house, and we'll go into all of the ways that you can finance that. So let's move on to people who are like, I don't really want to live in my investment property. I just want an investment property. There are multiple loan products for you as well at a slightly higher down payment. The next lowest down payment option is going to be a vacation home rental. So this is basically saying to the lender, hi, I intend on having a second home in a place that I will enjoy a couple of weeks out of the year. Typically, we see lenders wanting to see you spend at least 14 days out of your year in your vacation home. This is really easy to accomplish because during the setup period of your short-term rental, if you're planning on having any part of that, you can be there during that time. Also, it's like really good to spend some time in your short-term rental, if at all possible, to just figure out like things that guests might need to know about the property and to really know your property if you plan on self-managing. So in this scenario with 10% down, typically the lender wants to see that the property is 55 miles away from your primary residence. In some cases, there are exceptions. So let's say that you live in an area like me. I live in Denver, it's a metropolitan, and we have beautiful mountain communities that are only 30 miles away from where I live in Denver, but they are drastically different communities than where my primary residence is. A lender can look at a property, let's say for me, I have a property in an area called Rollinsville. They can look at that community and say, this is drastically different than Denver. This is a mountain community. We can understand why she would want a vacation rental here. It's not quite 55 miles, but it's such a different demographic that it makes sense for her to have a second home here. And so you can qualify using methods like that. Sometimes they'll want to see that it's in the mountains, or it's near a body of water, or it's near a golf course. It just has to make sense for them to loan you money for it to be a vacation rental. This is a great option because it's lower down payment and it is a competitive interest rate. The next type of traditional loan that you can employ is going to be an investment property loan. This loan product is still going to look at your financials as well as your credit score, but you're going to have a little bit of help in qualifying for an investment property because it will take into consideration what the property could produce as a rental property. So if you're purchasing an investment property for 15% to 20% down, a lender is going to look in a traditional investment property loan at what the property could earn from a long-term rental perspective. So unfortunately, in traditional lending, they are not going to consider what the property could earn as a short-term rental unless you have a few years of documented income. You could do this with 2 years typically of documented income if you want to purchase it as an investment property. This interest rate is going to be slightly higher than what you might see in a primary residence loan. It also should be slightly higher than what you would see in a second home, but it's still going to be competitive. In this scenario, a lender would do an appraisal on what the property could rent for if it was being utilized as a long-term rental. The last type of traditional investment that we're going to talk about is actually not not super traditional. This is going to be a DSCR loan, or a debt service coverage ratio loan. This is great for you if you own multiple properties or you don't have enough income to support another property purchase without it being considered a short-term rental. So let's say that you're someone like me who owns multiple short-term rentals and you write off everything on your taxes. A traditional lender might look at you and say, hey, we don't have any loan products that are available to you. You're maxed out on your debt to income, and it looks like you wrote off so much on your taxes that we can't use any of your earned income. This product is great because it will actually take into consideration what the property could earn as a short-term rental. Now, not all DSCR lenders have short-term rental products available, but many do now. So the benefit of this is that it is going to look at, let's say, a $500,000 property, and let's say that that property can earn $80,000 as a short-term rental. They'll say that this property has enough earning potential to cover the mortgage, and so we don't need to qualify this borrower based off of their income. We can qualify the home based off of the projected income. The pitfall to this property is typically the down payment is going to be higher. Typically, the down payment is going to be between 20 and 30%, depending on the location and the price of the property. Another pitfall is that it is going to be more expensive to borrow this amount of money. So you're going to see interest rates typically between 3 to 4% higher than what is offered in traditional financing. Another unfortunate thing about this loan is that there are often prepayment penalties, but I really do not believe that there is a bad loan product, especially if you are able to make money on the debt, because ultimately you're not the one paying the mortgage. Your tenants are paying the mortgage. And at some point, as you scale, every single investor has to look into some more non-traditional ways of financing, unless you just continue to increase your income and you reflect that on your taxes, which is then going to give you a higher tax liability. The next product that I want to talk about, I want to go back to some traditional loans for multifamily. So something that's really cool about purchasing a multifamily property is that you can actually use a low down payment on a multifamily if you choose to live there. So there are products between 3.5% and 5% down at much higher prices in multifamily. So let's say that you're looking at a quadplex. Here in Colorado, they will actually allow you to put as little as 3.5% to 5% down on a $1.5 million quadplex and help you qualify for that amount based off of what the other units can rent for. Like what we talked about in our original scenario, they are going to look at long-term rents in order to qualify you. And if you are putting this low of a down payment, they are going to want to see you live in one of the units for at least a year. But this is a great way to leverage a larger asset with a low down payment. And the coolest thing about real estate investing is that when you invest in real estate, the whole value of the property goes up, not just your down payment. So let's say that you buy a $1 million triplex. When that value of that asset goes up and you put only, let's say, $30,000 into it, you're actually gaining value on the value of the property, not just increasing what you put into it. So if that property increases in value by 3%, you're gaining $30,000 in equity every single year. So that's where it might make sense for you to invest in a higher priced asset like multifamily, because when the value goes up, the entire value of that asset goes up. Another traditional product that you could look into is something called a bank statement loan. I really love this loan product for entrepreneurs or people who have not been in their business for more than 2 years. A bank statement loan is more simple. They're not only taking into consideration how you document your income from a tax perspective, they're actually taking into consideration how much money is flowing through your accounts every single month. And they'll qualify you based off of bank statements. How much income are you making? What are your expenses? And they'll do a calculation based off of that. Bank statement loans are typically utilized for primary residence purchases. They can be used for traditional primary residence or something called a jumbo loan, which is a large amount of money being given for a purchase. So typically a jumbo loan is anything that is above conforming loan limits. In Colorado, at the time of this recording, that's around $825,000. So anything above $825 falls into the jumbo loan category. inventory, bank statement loans are a great option for you if you maybe do not have a traditional job, or you're aggressive when you write off your tax returns, or if you're someone who's not been in business for more than a year. Now let's talk about if you are wanting to purchase a second property, but maybe don't have a down payment accessible for a 10% down vacation loan or an investment property loan. You could actually leverage equity that you have on your primary residence, or if you have another investment property, you could leverage that. Leverage is the key component to you scaling your short-term rental portfolio. So a really powerful tool that you can use is something called a HELOC, or a home equity line of credit. So let's say that you have a primary residence and you purchased it for $500,000, and to make numbers easy, it's worth $1 million now. You're sitting on $500,000 of equity that is not doing anything for you. And so what you could consider is getting something called a home equity line of credit to take out some of that equity and put it as a down payment into an investment property that is going to make you money every single month. And so in the scenario where you owe $500,000 and the property is now worth $1 million, typically lenders will lend you up to 80% of the property value. So in this case, they would be willing to lend you up to $800,000. If you owe $500,000 and they're willing to lend you up to $800,000, you can take $300,000 in equity from your home. Just like in traditional financing, this is going to be financed to you at a particular interest rate and term, and you will have to qualify for the home equity line of credit. The coolest thing that we're seeing at the time of this recording is that there are lenders that are willing to lend you up to 95% of the value of your property. Deciding on how to finance your property will bring you one step closer to owning your Airbnb. Making this decision can be confusing and overwhelming, but we're here to help you obtain the best loan possible. Thanks for watching this video, and be sure to fill out our loan intake form so we can match you with the right lender.